There you can see the nature of business. Now, obviously, businesses do a few different things. Obviously, there's services, and we'll talk about each of those things that they do. We're going to talk about, as we move forward here, 3 different types of businesses, and we'll get to that in just a few moments here. So, as you can see here, the objective of most businesses is to make a profit. Yes, there are nonprofits, but for the majority of businesses, their job is to make a profit. And hopefully, take some of those profits and give things back too. That's what we're hoping for. But the majority of them are looking to make a profit. And basically, that profit is the difference between what we revenues that come in and expenses that go out. And we'll talk a little bit about that. And that's how your income statement is broken down. So we have revenues and then expenses. All right, so we have 3 types of businesses here, as you can see. As I mentioned, we're going to talk about these. So first is the service business. You can probably think of a lot of different service businesses that are out there. As you can see, Delta Airlines is a busy company providing a service out there, and that's what they primarily do. The difference between a service company and a merchandising business is that they're getting things here, they're selling it. So in here, we're providing some sort of service. Now we are getting cost of goods sold in here. So that's what we get at Walmart. And then we sell that to a customer. So that's the difference there. Now lastly, manufacturing business, obviously it makes sense there, it's manufacturing. So we're taking parts from other places and putting together a car, or whatever it may be, as they say there, Ford Motor Company. All right, so the role of accounting in business. And basically this is an information system that provides reports to users about economic activities and conditions of the business. So there's 2 types of accounting that we'll talk about. We'll talk about that briefly today, which is financial accounting, which is the class you're in now, and then managerial accounting, which is the class you'll be in next, after this class. And so we'll talk a little bit about those and what they do, what they mean to the company. Does anybody have any ideas there on what they are? Yet? Anybody know the difference between managerial and financial? Not yet? Okay. We'll talk about that in a few moments here. All right, so the process of which accounting provides information to users, first we want to identify the user, figure out who we want to provide it for, because it does matter. Then we assess the user's information needs, what they need, because if we're looking to provide stuff to managers, we want to be able to provide information that they can use to make decisions. So it's very, very important to be able to provide them the accurate information that they need that's useful. And so again, so that's why we choose our information system. So that's why so many companies have different databases, different things that they provide, is because it needs to be able to fit what they need to be able to provide to their people. And then you have, they record that economic data, and then you prepare all those reports that go into all that. So they can make good decisions as part of that. All right, so in here, this is kind of just how it works, and what I just kind of talked about there and how it's all fit in there. Also, if you want, it's in your book. I'm just going right along as the book there, so you can take a look at that if you'd like. Okay, so managerial accounting is basically about providing information to managers. That's really what managerial accounting is about. Where financial accounting, we'll talk about in just a moment here, is basically providing information to external users. Now, publicly traded companies are required to, because the SEC requires that if you're publicly traded, provide your financial statements out to the public. I can go out there on the internet right now and find you whatever public company you tell me about. I can find information. I can get every quarterly report, every annual report that they have out there about the company. I can find that information out. And so as a publicly traded company, that is a requirement out there. Why do they do that? So that way we can make decisions about how the company is doing and how their future is going to be using this information here. And so that way we don't have a lot of the issues. Now, some of the reasons this came about is because of the Great Depression. Some things happened at that time, and because of that, information was not provided out there. The SEC was formed. I believe it was 1932, because it was formed then. In 32, that's some of the things that they had to do is basically to provide all this information out there about your financial resources and what you have. And then it's obviously gotten a lot more than that. We'll talk about some of the reasons why that's happened too. So in managerial accounting, basically we're providing information for us internally. We're not providing this outside of us. So this is information specific. So what we're typically doing a lot of times in managerial accounting is we're focusing on maybe divisions, information about well, maybe how this division's doing, or this information about how this sector's doing, and part of that there. So that's just some of the things, or how we're producing this product. Because we need to make decisions on, well, what are we purchasing? How much are we purchasing of this? This good or whatever it may be to make this product. Maybe there's other places we can get that. Maybe we ought to take a look at our labor hours. Maybe it's taking too much to be able to do that. If we compare ourselves to other people in the industry, are we taking too long to do that? Maybe we need to automate. Or maybe we shouldn't because we have too many things going on. So those are just some of the things that have to be taken a look at. So managerial accountants employed by are a private accountant. So basically private meaning you work for a company. So if you're working for Boise Cascade, you're an accountant, you'd be a private accountant for them. Now financial accounting goes into what I was just talking about there. And the objective here is for users outside of the business, like I said. We're providing this because it's required by the SEC. You have to have the quarterly reports and then your annual statement that needs to be filed out there. And again, what they want to do is be able to provide information about really how the company is doing. So that way people do not make poor financial decisions on investing in the company or providing them a loan, because that could be that way too. And the general purpose financial statements are one that financial accounting report that is distributed to the external users. So we'll talk a little bit about what those are and what makes up those. So that's primarily what we will focus on in this class. Your managerial accounting will obviously be talked about in the managerial class. And so usually students like one or the other, a little better. And so we'll see what as you develop and what you like and some of those things there. Depending on your background, a lot of times it means a little more. I actually spend a lot more time in managerial. So I'm a little more familiar with managerial, but I do really understand financial. All right, the role of ethics. That's where we'll talk about some of the issues that have happened that cause some of the things that, all these regulations that we do have. Obviously, you probably could name a few things that have happened in the past. Then obviously it's very, very important that accountants must behave in an ethical manner. It's really important because a lot of people are making decisions. Useful, they want to be able to trust these people that are providing this information out to them. So ethics are the moral principles that guide the conduct of individuals. And so obviously you guys know what that is, and you'll probably hear that a lot more in your ethics class too. Okay. So these are just some of the things that have happened in the past. This is typically the one we always hear and see, the Enron scandal that caused so many people to lose millions of dollars as a part of that. And obviously it was billions if you add it all together because of all the things that happened. And also that was one of the things that started what we call Sarbanes-Oxley, that you may have heard about, which is called SOX. And so those are some of the internal requirements as a part of that that have been put in. We'll talk about later as we move through the class, but those type of things have happened and created other regulations and also opportunities for people in accounting because of all these regulations. Because now we have all these regulations, we need people to meet the demand for those regulations. So now there's a lot of jobs opportunities in accounting because of additional things that have happened. And we'll talk about a little bit, just a few minutes here, about some of the penalties for making some of these mistakes. All right. So the rule that, usually two things that happen here. So what went wrong with these companies, we'll talk about the two reasons that things that happen here. This is, failure of an individual character. Person decides not to follow because whatever it may be, or to cover themselves for the job. Sometimes that does happen because the expectations for these companies are so high that they need to be able to produce. If you don't, you may not have a job. So sometimes you toe that line a little closer, whoops, and that can be a problem. Also, the culture of the whole company may be that way. And that starts from the top, the CEO. If the CEO believes that we got to do whatever it takes to be successful, then the people, it starts feeding down that way. And so those could be both problems for the company. Now, as I talk about that, let me slide back real quick here. As I talk about that, there are some of the things that can happen. Now, because of Sarbanes-Oxley, there are regulations, additional rules for internal control, but also there's penalties. So the CEO signs off on all these financial statements, If there's a misrepresentation, the CEO can not only be fined heavily, but can also go to jail. Same with the CFO. So those things now, now it's a personal thing to those. Because before, you could get away with it, and yes, you may get a fine or something like that, but it really wouldn't hit them as hard. Now, there's something that's additional to that. So you're signing off on this. So as a CEO, you are trusting your people to provide you accurate information. That's one of the tough things about it. You're trusting your employees to be able to provide. Now, as long as you're not misrepresenting. If something is wrong because of not a real problem, fault of theirs, then that's different. That's not misrepresenting. But if there is something like that, then they can potentially go to jail and spend a lot of time in jail. And so that can be a problem. And so why CEOs are a little more careful now than they were, let's say, 10 years ago. All right, so I'll let you guys read through this real quick. Can you guys see that okay? Back. And those are some of the ethical guidelines. They're obviously, like the last one there says, make a decision as ethical and fair to the people that are affected by it. Those are very important things, like I said. And things are changing a little bit, but there's still going to be people and companies out there that go that line a little bit. So there's something to be aware of there. But one of the things we wish, especially as a Christian school, we would wish that ethically they would make the right decisions. But now we've had a transition from we're trusting them to do it. Now we have to put regulations in there to make sure that they are doing that. That's some of the things that are difficult in some ways, and it does cost us a lot of money here in our country because of all these regulations, because it costs a lot of money to be in compliance with all these regulations. That's a part of that. All right, so accountants and their staff who provide it based on a fee is public accounting. So you'll see that more as like a CPA. Those are the types. I think it's on the next right here. That's a certified public accountant, that's a CPA. They provide it to outside people. It could be other companies too. So CPAs will provide accounting help for companies, especially smaller companies, they'll provide it for. But they'll also do auditing. So that's the other portion of that too, is they audit a lot of the companies. That is required by SOX, Sarbanes-Oxley. As a part of that, you have to be audited by an independent auditor. So they'll have they may do auditing also for companies because that's required by the SEC. So questions so far? Now I mentioned before, because of all the regulations and everything that's happened, accounting has grown. Even in the time frame of the last 5 years when we were struggling in our economy here, accounting was still hiring. It's because there's so many regulations and so many things out there. And you can see some of the starting salaries right here. I'll let you guys take a look at that. There's lots of opportunity out there. So if that's where you want to head to, let me know. We have an accounting program. All right. So, one of the things we're slightly objective to, one of the things we're going to talk a lot about, and you'll hear me say GAAP a lot. You've probably heard of GAAP. That's generally accepted accounting principles, and we'll talk a lot about it here. This is where we base up all of our accounting here in the United States. And so you'll hear me refer to that probably throughout the class. Now, what you'll hear is this is the FASB, which is the Financial Accounting Standards Board, which is within the United States. They basically provide the information here. They set our accounting standards. They set the GAAP. Now, the SEC, which I referred to several times already, is the Securities and Exchange Commission, which is basically an agency by the U.S. government that oversees the accounting and the financial disclosures for companies and shares of stocks. So if I'm a CEO of Disney, if I want to sell my stock, I actually have to notify the SEC before I do it, because I may have some insider knowledge of what may be happening. So I have to notify them within a certain amount of time frame before I can sell or buy. I have to let them know. And so that way the public is let know also. So you can actually go out there and see, if you pull something up, go, like finance.yahoo.com, and just type it in, you can see which ones are doing what. And so you can see a little information there, because if you see a CEO starting to exercise their options, that type of stuff, well, maybe there's something going to be happening. But that's one of the security measures to help, because obviously they know a lot more than we do about what's happening with the company. So, but that's what the SEC does, is they try to provide protection for the investors out there. So many countries outside the United States use Shelby accounting principles, but this is developed by the Internal Accounting Standards Board, IASB. So because of that, there is some differences there. You'll hear me talk about this throughout the class too. They're right now in a convergence of trying to put these together. We are one of a few countries that are still left that use our similar accounting standards, where most of them around the world, about 100 different countries, use the international standard. And one of the things, the difference is because it makes it difficult for us to figure out what it's really worth, the company, because the accounting is different. How it's done. One's on principles based, one's on standards based. And so that's one of the reasons why they're trying to put it together, so that way we can evaluate a company here in the United States, maybe HP versus Toshiba. How are they the same? Now, one of the things is, though, HP still does provide a lot of theirs to the international standards, because they have so much international stuff that they do. But if you were to add a company that wasn't, then it would be harder to basically evaluate the differences between the companies. So that's one of the reasons why we want to have a seamless and similar standard. All right. Now, what we'll talk about here is the business entity concept and what it really means here. You'll talk about this in your business classes. So I'm just going to do a quick overview of this here. And so basically, what is the business entity and what is it? So a sole proprietorship is owned by one individual. So when I was that professional golfer I was telling you about, I was just myself. Yes, I had an employee that paid, which was my caddy, but that was pretty much it. It was me, I was the owner, that's it. Whereas when I ran another company that brought me up here, we were under an S corporation, which we'll talk about in a little bit here. So here, you can see 70% of business entities in the United States are proprietorships. So quite a few. But they have a low amounts of revenues that they have in comparison to when we talk about the companies. And so they're usually easy and cheap to organize, not very difficult at all, and resources are limited to those owned by the owner. So that means all you're able to do is put whatever the owner has to be able to put into the business, whereas the companies are able to then get capital in other ways, because there's other things that they have as a part of that. And used by small business, really. Now, a partnership, which will include the LLCs, which we've seen a lot more growth in the last 10 years in the LLCs. Basically, what that stands for is limited liability companies. And in those LLCs, what it does is does provide protection for the individuals. Typical partnerships do not. So in partnerships, it's 2 or more people that are involved in this here. When in a partnership, if I did something, let's say if I was in a partnership or it is in a proprietorship, and I was playing golf and I accidentally hit somebody and it caused harm to them, my liability insurance that I don't have any, say I don't have any, and the golf tournament doesn't have any, I would be liable. They can come after my personal for that. Now, in a corporation, it's a little different. You only put in what you have there unless you do something illegal and morally wrong. You only lose what you put into it. So if I had invested $10,000 into a corporation and I have $40,000 in debt, they can't come after my personal assets on that unless I did something really wrong. They can just only go after what I have left. And so that's why they say you're only going to get 40 cents on the dollar or 30 cents on the dollar. That's the reason, so because that's all the assets they have left versus what they own. So there's a little protection for that. So that's why you see the LLC popping up more and more, is that protection there. Now, one of the things is it combines the skills and resources of more than one person, so you have more things that you're able to do and use. Now, a corporation is organized under state and federal statutes as a separate legal taxable entity. So it depends on your state where you set this up. We usually talk about this, I think they pulled that out of there, but there's different states that are more favorable to setting up your
Delaware.
Yeah, Delaware is number 1 actually. Yeah, that's good. And so that's where a lot of companies set it up, is in Delaware because of that. Nevada is probably I think number 2. or where they set it up, because they're very friendly. Their taxes are a lot lower. And you don't have to have residents in there to set it up in there. So if I wanted to set up a company, I can actually do it in Nevada or Delaware and not have residents there. You don't have to. So that's why they choose some of these things there. It's a little easier if you're there, but it doesn't have to be. So corporations generate 90% of our business revenues, like I was telling you about before. Most of our revenues come from these big companies, even though they're a small amount compared to how many proprietorships that there are. And 28% of the businesses organized in the U.S. are corporations. And typically their ownership is divided into shares and they're called stock typically. And we'll talk about that in the later chapters, how that's all broken down. And we'll take a look at that. And obviously they have lots of more resources. Used by different large businesses. So I just talked about the LLC a little bit. So you kind of know about that already. And that's 10% of the business organizations in the U.S. And they're growing a bit there. Even bigger companies are LLCs. You'll see them start off small and continue to grow and still keep that LLC. And it's used as an alternative to a partnership. So one of the things with a partnership is, I didn't say this before, but if a partner dies, the partnership is dissolved because that's the way it was set up as a partnership. You learn about that in advanced financial accounting, those who are accounting majors, and how that's broken down, how that's separated out. But the commitment is between those two, and if one of them passes away or something like that, the partnership is no longer. And so a portion of that money goes to somebody else, the heirs or whatever, and so now you got to figure out what to do as a part of that. And so those are some things to be aware of, where an LLC is a corporation, it's a separate legal entity. So it's on its own, it's on out there by itself. So you can sell that, you can move off, that doesn't change how the company's set up. It's separate. And so those are things to be aware of. Like a proprietorship, if I were to die, my company's gone because it was under me. That was my ownership. So I then have to make the changes there. My heirs have this stuff and go to them. But it's basically gone from that point because it's not no longer mine. And there's also tax, and I told you about the legal advantages of those type of things there. We'll talk about the taxes a little bit later. All right. So let's start looking into accounting. We've talked a lot about a lot of other things for the first half hour of class here. We haven't talked a lot about going into what accounting is. Now the cost concept is what we're going to talk about first. So the cost concept basically says this, is if I purchase this thing for $5, that's my cost. That's what my cost is. So the cost concept doesn't say now what is the value tomorrow or the next day. It may have gone up to $10. The cost concept says, okay, I purchased this for $5 and that's what it is. So the cost concept here, as you can see, purchase a building for $150,000. And these are the other amounts related in the next slide. So we'll take a look here. So we purchased this on this date for $150,000. Price is listed by the seller as this. This is what we offered. This is what we purchased it at. This is the estimated selling price, and this is what our assessment is, property tax. But this is really what the cost concept is, and that's our foundation for that. And we'll talk a little bit about that more and more. If you open your books, there's a sample problem that I'll let you kind of read through real quick so you can get that. It's on page. It is on page 8. I'll let you take a look at that one there, and I'll let you read through it. It gives you the answer at the bottom there, but just take a look at it. Make sure you have a good understanding of what that is. Now as you read through that, I typically will take a break at 7 and give you guys about a half hour to grab some dinner. Give you some time there and we'll work through after that. Is that a work for everybody? Do something like that. And tonight's probably not as big a deal because most of us came from home and we're working, so it's not as bad. Coming from work, probably once a little break for perhaps a game or something like that. All right, so questions how they came up with 137? Pretty simple stuff. All right. So that's the cost concept. So keep that in mind as we're working through some of these. You'll probably see this problem, I think, in one of your homework problems. So much one of that, you may already see that. All right, so the objectivity concept requires that the amount recorded in the account of records be based on objective evidence. So what is it worth? Now, this is kind of a little bit more of what we would like to know about, because I really, if I'm evaluating a company, I don't want to know what the company is worth. You know, that building we bought 30 years ago, how much we bought it for. I want to know what it's worth right now, because that's my asset. Is it really $500,000 or is it $10 million? Because now it's $10 million. Let's say. I really want to know what the company's really worth. So the objectivity concept is a little different on that. So now only the final agreed upon amount is the objective enough to be recorded. Oops. As a part of that. So just be aware of that, not because what we think it's worth, what is it really we sold it for? That's really what it comes down to, what kind of records. All right. Now the unit of measurement, primarily we'll be talking about is dollars here. So just be aware of that. Obviously other countries may use other things for obvious reasons. We use dollars here. All right, questions on that objective and that stuff there, the cost concept, any of that? Okay so far? All right. Let's move on. So now let's talk about the important foundation, the beginning of where we really need to understand here. So in a accounting equation, we have three different things that we're going to talk about. The first is assets here. Everybody know what an asset is? Anybody give me an example of an asset? Cash? What? Okay. Building? Yeah. All those type of things are assets. So basically, a lot of times tangible things that we can hold or that we have as an asset. So this table, this chairs, that camera, this, all that is an asset. But there's also intangible things that are a part of that too. Coca-Cola is one of the biggest brand names out there. Their name alone is worth a lot of money. So just having that name is an intangible asset because we can't hold it. We know what it is. It's worth something there. And so they have to kind of make an assessment on how much that is valued as. So that's another asset that can be out there. So all those things there. So if you think about your asset personally, you have your house, you have your cars, you have the things inside your house, those type of things there. Now the next thing is liabilities. So liabilities are basically things that we owe on. So simple things like, we may have our credit card as a liability, and you'll probably hear me say that may fall into accounts payable. We may owe that. So that may be an accounts payable thing. Or you may have a mortgage. That's something that we owe on, right? So a mortgage. And then you have notes payable, you'll see that. That's more for businesses that you have a note that we have to pay on. And then what we have is stockholders' equity or owner's equity. And so you'll hear me refer to that as OE. But that basically is the rights to it. The rights to that, whatever it is. And I'll give you an example here in just a moment. And so this is the equation here. So we have assets equals liabilities, and I'm going to shorten this, plus owner's equity. Okay? So as you see here, now I'm going to give you an example real quick. Know this equation and how it breaks down. This is the foundation for your balance sheet. As you can see, it's called a balance sheet. We're going to talk a little bit about must balance. So each side of that equation must balance. So if I bought a house for $100,000 and I have an $80,000 mortgage on it, well, what's my equity on it? $20,000. Good. So we have $20,000 in my equity on that. That may be what I put down right now, so that would be my equity on that. So that's how much equity I have in it. That's my owner's equity. So think of it kind of that way. So if I have a car, it's $25,000, and then I owe $15,000 on it, well, that means I have $10,000 in equity in my car. So if I were to sell that car and I get what I have it valued at here, I would then have $10,000 left over, minus all the transaction fees or whatever it may be. But that's what we have there. So what we have is that's what our owner's equity would be. So that's my equity I have in that. Everybody pretty good there? No problems? All right. All right. So again, assets are the resources owned by a business, and liabilities are the rights of the creditors to that. So those creditors, their rights to what that is. And that's the rights to the owner, is the owner's equity. All right, that was a quick one. All right. So let's move on then. So let's take a look at some business transactions. So a business transaction is an economic event or condition that directly changes an entity's financial condition or its results of operation. So it's something that changes that. It's a commitment that you will come into my store and you may come in and say, hey, I want to purchase this, I'll be right back. Can you put that aside for me? But they never come back. Was there a commitment? There was anything that changed hand that made us really think that was going to happen? No, so that's not an economic event. No one considers that. Now, if I gave you 20 bucks and says, hold this for me and I'll come back and pick it up in my truck because it's, let's say it's a lot bigger than this. And yes, I made the commitment because I have, and then they made the commitment to me that they're going to give me that product. And so there's been that exchange there. So then we have a business transaction. All right. So in here, we're going to walk through about, I think it's 8 or 9 transactions right now. And we're going to take a look at how this all works. So first, we're going to start it off by, as we start up a company. So this gentleman here, Chris Clark, basically puts $25,000 in. So we have $25,000 in our assets, because that's our cash, and then he has capital stock of $25,000. If he pulled that out, he would get the $25,000 back, right? Now, we're not taking a look at his personal side. We are only looking at the business side, okay? So just be aware of that. We're just looking at the business. So we have, as you can see, this equals the balance sheet. So everything will equal. All right, so the next thing that we have here is we know we have $25,000 in the cash. We want to then purchase land. So we decide to purchase land, it would cost us $20,000 to purchase that land. So because of that, we are going to take away from our cash. So we're going to reduce our cash by $20,000, but we increase another asset, which is land. So now we have, it still equals that we went up and down in our assets. That's the difference there. So you can do that. So on one side, only affect one side, but it still must equal when we're done. So far, so good? All right. So next transaction here is we need to pick up some supplies. Maybe we need some papers, pens, all that type of things. So we go down to Staples. We buy $1,350 worth of supplies. Now we decide to, this time, instead of paying cash, because I want to keep my cash there, and we'll talk about how the importance of cash is later on. We decided to put it on accounts payable. So we decided to put it in, basically we owe them that. We have to pay them within 30 days or whatever it may be, whatever we have to set up as. So it's a promise to, a commitment to pay them. So as you can see here, we add this, and then we add this. And so it still balances. Questions so far? All right, back up here. So transaction C, you see the liability created by a purchase of account, which is called accounts payable. And then the items such as supplies that will be used in the business in the future are called prepaid expenses. And we'll talk a little bit about prepaid expenses and what that means. Basically, you probably do it all the time. If you pay rent, you pay things, you pay ahead of time. Well, we all do that for our insurance, for our cars. We pay it ahead of time before we actually use it. So when you rent a place, you pay on the first for that whole month, right? And so that's basically a prepaid expense. We paid it ahead of time. And so we've done the same thing with supplies. We have paid the supplies ahead of time. We'll use some of those supplies, and then we'll expense that out at the end of the month from what we've used. All right. So moving forward here, in transaction D, we have some revenues that come in, which is a great thing. So we're now bringing some money here. So we're going to add cash here, but we're also going to add fees earned here. So that, and this, many of you will think, well, wait a minute, why is this in the balance sheet? I'll show you why in just a second here. But it's a portion of that, because it feeds into the balance sheet. So we have fees earned of $7,500 and then $7,500 over there. So cash and then fees earned. Questions so far? Make sense? So revenue provided services are recorded as fees earned. You'll see it called several different things depending on the type of company we are. It could be fees earned, it could be sales, it could be just revenue. You may see it a lot of different ways when we talk about it, but just know that's money that's coming in for something that we have done and earned. All right, revenue from the sale of merchandise is recorded as sales. And then other examples of revenue include rent, which is recorded as revenue. Then we have interest revenue and those type of things too. Because if we provided a loan or something like that. And an account receivable is a claim against a customer, which is an asset. So we'll talk about that in the next one, I think here. Yeah, we don't think But just think of accounts receivable. Where most students get confused is accounts receivable, accounts payable. Accounts payable, remember, I owe that to somebody. I have to pay it to somebody. Receivable means I'm getting the money in. They owe me. I did your landscaping for you. You owe me $100 for doing what I did, and so that's your commitment to pay me. So it's owed to me the job that I've done. So think of that about that as an accounts receivable, or something else I may have done, legal fees or something like that for you. So just remember that commitment there is what that is. There. All right. So during the month, net solutions spent cash or used up other assets in earning revenue. Assets used in the process of earning revenue is called expenses. Let's talk about some of our expenses here. So we have a list of expenses that you can see here that are given. We have wages, we have rent, we have utilities, and we have miscellaneous expenses. And so we're going to put those all on this side over here, the stockholders' equity. Now, one of the things you're going to see is go, wait a minute, I thought expenses go probably on the income statement, right? You're right, it does. We're just kind of showing it to you this way. Because this, your income statement, feeds into this. So just be aware of that. We'll get to that in just a moment here. But basically, you're going to have your fees earned here, your expenses there. And then obviously we have to pay something for it, right? We have to pay cash. All right. And then we decide we're going to finish up here and figure out what we have left. So on hand, we have $550 of supplies left. So that means we used up $800. That's why we're taking away $800. Because we started with $1,350, and now we have $550 left, so that gives us $800. And so now we reduce our asset, and then we expense that out. I lost anybody yet? Okay. All right. So on November 30th, Chris decides I need to get paid, so he pulls a dividend. And so he takes away $2,000 out of his cash, and then he subtracts the dividend. Typically, you'll do this as a withdrawal. You decide to put this as a dividend here, but just remember it as that. Something that's been taken away there. All right, this is a summary of what we just went over. It seems like it's a lot, and we'll kind of walk through some of these problems and what it all means and everything there. But as you can see, step by step, how does things go? We'll kind of go over those things there. So questions so far? All right. Now, one of the things as you take a look here is basically this. These are all of our fees that we earned, and adding all this up, what did we make? This is our net income there. The revenue is, and so we're going to talk about that when we go into the income statement. We're going to do some practice problems after we come back from dinner on some of that too. All right. One last. Let's go over to this last slide, and we'll take a little break here. So the effects of every transaction is an increase or a decrease in one or more of the accounting equation elements. So it's an increase or decrease. Just be aware of that. The two sides of the accounting equation are always equal. Like I said at the beginning, it must equal. And then the stockholders' equity is increased by the amounts invested by the stockholders' capital. So if I put money in, it goes up. I get that money. I have that right to it. Let's take a break right there, and we'll come back in just a little bit if you guys want to take a break. If you have any questions, please feel free to stop me.